Thank you for your time today. Let's get going. Welcome to basic training session number 2. Today we're going to be talking about the settings page. We'll also be talking about creating entries, and then finally we'll be talking about notes. So first of all, on the settings page, I want you to notice that you can put in 2 rates of inflation. One is a general inflation assumption, let's call it the cost of groceries. The other would be for government affected programs like OAS, CPP, also the tax bracket indexation, things of that nature. I just want to point out as well that when it comes to the general inflation rate, which would apply to things like property taxes, for example, and let's just go there so you can see this, that you do have the ability to go in and on an entry by entry basis, control the indexation rate that you apply. So my favorite example of that is, of course, property taxes. For those of us who live in the Toronto area, we know that property taxes have gone up at a far, far faster rate over the last number of years than the government or general inflation assumption. By the way, for that rate, we use the FP Canada rate just so that it's, the acceptable rate to use. What we'll be doing, by the way, when I mentioned the ability to control things like the indexation rate for property taxes, is we'll actually be covering that in the basic training part 3 series that we'll be doing next Monday. So let's have a look then at the Canadian US dollar rate. You can set a universal rate here, which in turn controls the conversion of US dollar holdings to Canadian dollars. So you can see that this is picking up the default setting on the settings page. And then all you need to do is select that checkbox, and any portfolios that have US dollars in them will then be converted to Canadian dollars. That won't be on screen in the input. It will be in the printed report. Let's go back to settings. You can see the inflation US dollar rates. These are historical rates, just for your information, giving you the ability then, for instance, to have a look at the historical rate and then change the Canadian US rate as you wish. Real estate is very important. So when you create somebody in the plan, what happens is that we know their province of residence. And so automatically when you create a property, their home, cottage, for example, then what's going to happen is that the real estate rate for their province will be applied to that particular entry. And these real estate rates are from the Canadian Real Estate Association. So for example, if you had somebody that, let's say, had a cabin in Alberta and you lived in BC, then you could have a look and see what the long-term rate has been for Alberta and then apply that if you wish to. But otherwise, the default will be for your province of residence. And once again, and again, we'll be doing this next Monday in basic training part 3, you can go to a specific property, its appreciation rate, and then change that rate to anything you want. And you'll find that you can change the rate over time. So you could, make it a much lower rate today and then put it up to a higher rate sometime in the future. Do whatever you want to do over time. But again, that's for next week. There was one other thing that you can see here, which is the capital gains rate. And that gives you the ability then to apply a different capital gain rate over time. And you could literally apply it year by year if you wish to. So let's look at the main bank account. There are 2 possibilities when you're dealing with a couple. One is that you can have individual bank accounts. Bill would have his own bank account, Sue would have her own bank account. And again, as we go through the basic training, we'll be talking more and more about how the bank account works. But essentially, it's the central processing engine for all cash flows. So paycheck income goes into the bank account, grocery bills get paid from the bank account. And as we'll see when we get into the advanced training, you have complete control as to what you want to do. So if there's excess cash, more coming in than going out, then you have the ability to direct where you want that excess cash to go. Matter of fact, we'll just jump down to solutions, the tactics tab, and then for Bill, we'll go to the excess cash tab. And you can see right now that the default is to go into the joint non-reg portfolio because that's what we've set up on the settings page. But it could go to Bill's non-reg portfolio. If there were unused TFSA or RSP contribution room, you could indicate that you want any excess cash to go to those two in order to, top things up. You could have liabilities that you wish to pay down. So there are just a wide range of things you can do. Similarly with the main bank account, and especially when you get into the retirement years, if there's a shortfall in the bank account, not enough money is coming in to meet the expenses in a year, then what you can do is control withdrawals. And you can control withdrawals pre-retirement and post-retirement. Generally, pre-retirement, we would be drawing down on either a high interest savings account or perhaps a non-reg portfolio. But once we get to retirement, then that's when we can start talking about drawing down on RIFs or TFSAs or some combination of the two. And again, something that we'll cover in the advanced training. But the point is that you've got complete control as to where you want excess cash to go, or similarly, if there's a shortfall in the main bank account, what sources you want to draw down from. Now, generally speaking, if you're working with couples, it's much easier to use a joint bank account and a joint portfolio. If you're using individual bank accounts and portfolios, the problem is that one person could be earning more than the other. Therefore, you have to start changing the percentage split of expenses. That could be different in the pre-retirement years from the post-retirement years and so on. So it's definitely more awkward to work with, whereas the joint account, all of their income flows into the joint bank account. And as you've seen, if there's excess cash, you can direct it to the joint main non-reg portfolio. So that just makes things a lot easier when working with couples. The issue, however, when you're working with couples in a joint main bank account and therefore joint non-reg portfolio, is that one party in the plan could earn substantially more than the other. And the problem then with using a joint non-reg portfolio is attribution rules. And I think we should be paying particular attention to those. We know that the government is looking for every possible source because of all these large budget deficits. And I wouldn't be surprised to see individual tax returns being audited looking for the incorrect reporting of joint investment income. However, in VisionWorks, even though the portfolio is joint, meaning joint tenant for right of survivorship, and therefore on Bill's death, his portion of the portfolio automatically transfers to Sue and bypasses probate. What you can do is you can put in a financial interest that's different from the joint JTWROS interest just for ownership of the portfolio. So this financial interest, you might have one person who makes 75% of the income, the other 25%, and therefore we'll assume if we don't have the correct information that one person has a 75% interest, the other has a 25% interest. On a go-forward basis, once you've established the starting share, in the background, VisionWorks actually tracks what somebody puts into this portfolio, what expenses directly that are their expenses come out of the portfolio rather than joint expenses. So in the background, every year, it's actually tracking a changing financial interest in the portfolio. And then what it does each year is it takes that new financial interest and it applies the split of interest, dividends, and capital gains based on that. So from the point of view of working efficiently around cash flows with a couple, joint works. It's the easiest thing to do. And the software is taking care of the relative proportion, the financial interest of the portfolio in order to make sure that we're not contravening any attribution rules. The last thing I want to look at on the settings page is management fees. Now, applying management fees here means applying them universally to all portfolios. So we don't recommend actually doing this. It's a little more work. However, if you go into an individual portfolio like the joint non-reg, for every individual portfolio, you'll see a management fee button. So let's just add in the fee. And what you see now is you have much greater control. Should the fee be deducted from this account? Is the fee tax deductible? I could even go in and have Bill pay the TFSA fees for Sue, for instance. This is showing a dollar amount. That would just be a flat fee, but you can put in a percentage amount. And these percentage amounts can be flat, 0 to 500,000, 1%, 500 to $1 million, 0.5%, and whatever you might enter above that. Or they can be graduated. So the first $500,000 at 1%, the second half at a different percent, and so on. That handles the management fee question. So that covers everything on the settings page. And we can come back and talk about any questions that you might have a little later. What I want to do now is go down to entries and talk about the creation of entries. And the first thing that I want to point out is that assets are entered on the tab of the owner. So you can see here that I have the ownership entry for the jointly owned home, which is JTWROS, on the joint tab. But I want you to notice, and I use this example all the time, that I actually have the ownership of the cottage on Bill's tab. So I want you to assume that this is a second marriage, blended family. In Bill's previous relationship, his wife took the house, he took the cottage, it's his asset. So it would go on his tab. Now, it's important also to understand that, and this is not uncommon, so I'm just going to go to ownership and I'm going to add Sue in here as a 50% owner. And when I do this and save, I want you to notice that the cottage disappears from Bill's tab and it's now showing up on the joint tab. And just so you know, this feature is also what allows us to properly model wills. Assets are connected to people through their ownership interest. On death, the asset continues to exist, but under the terms of the will, the ownership is disconnected from the deceased who owned it, and it's connected to the new person who's the beneficiary under the terms of the will. So this ability to change ownership is important. So last week, for example, there was a coaching call where somebody had gone in, Bill is at the top of the list in the tabs. She'd entered 3 homes on Bill's tab, only to realize later that she needed to put them on the joint tab. So all she needed to do was add the Sue to the owner's list, and then everything moved over. So it's pretty easy to do, pretty efficient to do. But again, the point of this exercise is the ability to add assets to the tab of the owner. The second thing that I want to talk about is income and expense entries. And again, I refer to creating these entries as being on the tab of the doer. So when it comes to a university expense, for example, for Bill Jr., I'm not adding it on the joint tab, nor on Bill's tab or Sue's tab, which would probably be quite typical of other software, you know, them being the payers of Bill Jr.'s university expense. But what I'm doing instead is I'm actually adding it to Bill Jr.'s tab. And the reason I'm doing that is because in the software, there is a separation of who owns assets, who does things, from who pays for those things. So if we go to show table, you can see here that we have Bill and Sue as the payers. By the way, if there's an RESP, the funds in it will be used first. And if they're
thanks, honey.
Then Bill and Sue would be the payers. But the reason for doing this, putting entries like this on the tab of the doer, is because anybody could pay for Bill Jr.'s education. And in today's world, it would not be uncommon, for example, for grandparents to be partial payers. Now, we don't see them in the list. We would have to add their names on the About page in order to do that. But if we just want to account for the fact that they're paying for half of the education expense, then we can just use non-party and add them in and then split whatever Bill and Sue might pay. So we put the entries on the tab of the doer again because anybody could pay for them. And this also applies to assets. So I want you to imagine for a moment that Bill Sr. is actually in the plan. And Bill Sr. may be the owner of the cottage. Again, not uncommon. Bill Sr. is 85, he owns the cottage. However, he's not paying for the property taxes and the operating expenses. Instead, Bill, who's working and has the income, he's the one that would be paying for it. So again, I could create Bill Sr., have the cottage on his name, he would be the owner, but I could have Bill paying the expenses. And again, something that's relatively commonplace. So just keep in mind, assets on the tab of the owner, dues, if you will, go to university on the tab of the doer, Bill Jr. Going to university. And then we have that ability to control separately who the payer is. So how do we get these entries in here in the first place? So there are actually a couple of ways to do it. When you're first starting out, you can use the entry menu. So just click entry, create. And then if I wanted to add something like a Sunbelt home, I would just click Sun entries, create. I've got the house in there. So I want to add a renovation expense. So all I have to do is click renovation. And now I've added a renovation expense to the house. So I can add entries from the entry menu, and it's fairly easy to identify, you know, where the different entries might be, for instance. Or alternatively, what I can do is I can use the button palette. And I want to speak about this a little bit. So we talk about two groups of buttons. If you notice, there's a line, there's an upper group of up to 8 buttons, and then a lower group of up to 12 buttons. And just for convenience, we call these the A buttons and these the B buttons, the main buttons, the secondary buttons. So if I wanted to add an A button, let me just delete this renovation for a second. If I wanted to add an A button, like a Sunbelt home, I just drag and drop it onto the tree view. I can give it any name I want. If I want to add a B button entry, let's say that kitchen renovation, I would click that button and then I could type in, what I wanted it to be. Whenever, by the way, you see an entry editor come up, whether it's for homes, renovations, or whatever, it means you can enter multiples of these. So I could renovate the kitchen, the basement, bathroom, whatever it might be. So we drag and drop upper buttons, we click lower buttons, and also just please be heads up about menus. You might see a little triangle next to a button. If I go back to lifestyle, for example, in entertainment, you'll notice sports, clubs have these little triangles. When you click on the button, it means a menu opens and you've got multiple choices. So some people will try and click on that clubs button without selecting, the menu item. Or if I go to Bill and his career income, some people might create a salary entry, or want to create a salary entry, but notice I have both salary and bonus, so I can create those quite separately. So drag upper, click lower, be heads up about the menu items. The other thing that I want to talk about when you're dealing with these buttons is how do I identify necessarily what a button is used for? So if we look at, for most of them, it should be pretty self-evident. But if we look at rented, for instance, is this a rental property? Is this a place that I rent? What does rented mean? So I just want you to be aware of what's this help. If you click help, what's this help? Then the pointer turns into the help pointer, little question mark. We talked about this last week. I can now click the rented button and get an explanation of the use of that button. So this is to rent a place like an apartment, condo, etc. And then notice it says here for a rental property, from which you receive rental income, that's a little different. So one side of the coin is what is this thing that I see in front of me? And for that, you're using what's this help. The flip side of the coin then is where do I go and find something? So if I go to help topics, I can go to the where do I find index. You need to double click that and then the index itself. And then what I can do is click on the letter R for rental property. And then notice there it is, rental property. And this is directing me to other rental properties. So in the tree view, all I need to do is go to other, and then I see rental property. And then of course the question is that on the joint tab, Bill's tab, or Sue's tab? Who's the owner? So just keep in mind, what's this help, and also where do I find help? Now, one of the things we haven't spoken about today is creating liabilities. So liabilities are not created in some menu item, like an accounting balance sheet, here are my liabilities over somewhere. Liabilities are actually mostly created through the thing to which they're attached. So if I go to the buy sell panel, notice there's a financing button, and now I'm able to add a mortgage, a line of credit, a reverse mortgage. And the reason we do this is because when that liability is connected to the thing, then we know is interest on the liability tax deductible or not, for instance. And this is particularly important for rental properties, keeping in mind that many clients now own them. The rental liability, the interest on it, has to be deducted from net rental income. So gross rent minus deductible expenses like property taxes, operating expenses, gives us net rental income. And then from that, we have to deduct the interest on any related liabilities. And once the interest has been deducted, then we can make a CCA claim, but the CCA claim cannot turn the rental income negative. So it's very important that we deduct the interest on the rental property first. If we don't do that, we can overstate the CCA claim, for example, and ultimately CCA recapture, et cetera. And I think you'll find that's one of the major problems with other software is there isn't that direct linking between a liability, for instance, on a rental property and the thing itself. Liabilities are created through the thing. If we're talking about general liabilities that have no particular asset or expense related to them, then go to portfolio accounts, credit line, personal loan, and you'll see line of credit, personal loan, spousal loan, student loan. By the way, if I go to Sue, now it says spousal loan. And if I go to Bill Jr., it actually says related party loan. So I may have lent money to a relative, for instance, that I could enter in. The last couple of things that I want to talk about are actually notes. And there are a couple of ways that you can handle notes. One is that you can attach a note to a specific thing. So let's go to renovate the kitchen. If we right-click, up comes the right-click menu. And again, next week, we'll be talking a lot about the right-click menu. And when it comes up, I can add a note to it, whatever it might be. And you'll notice when I click OK, that there's now a little asterisk attached to that entry, reminding me that there's a note. The problem is when I collapse this, 6R Street, let's say I go to the Sunbelt home, I no longer see that there's a note attached to that specific entry. So I'm not a particularly big fan of attaching notes to specific entries. By the way, if I right-click, click note, and remove that note, then that asterisk will no longer appear. So instead, notice that there's a notes feature at the top of the window in the menu bar. And this is where I recommend that you put in your notes. So as you're doing a plan, it might be information you need to collect from a client. It might be a question that you have as you're assembling the plan and so on. So this is a convenient place to add your notes. Notice that the notes window or the notes menu item now has a little asterisk, and it doesn't matter where I am in the software, I always see the notes window and see the asterisk. What I would recommend is as you add different notes and as you collect information or discuss something with a client, I would not delete the note. Instead, what I would do is I would use this little strike through tool or strikeout tool. So all I have to do is just click that and then I put a strike through it. So that ends up becoming an excellent audit, if you will, of the things or trail of the things that you discuss with the client, over the period in which you create the plan. And I think that's a very handy feature. So those are the things we wanted to cover in basic 2. The basic training is just to get you going so you can create entries. The one we do next week is going to be, really the key one. We'll talk about, now that you know how to create entries, we'll talk about the different types of entries, how to quantify them, how to change, an expense over time, things of that nature.